If you're watching this video right now, it is 8 p.m. Eastern Standard Time on Sunday, February 8th, 2026. I have been staring at this screen for exactly 2 hours and 17 minutes. I watched the open, I watched the candle formation, I watched every single tick, and what I'm about to show you is not speculation, it is not theory. It is a confirmation pattern that has happened 3 times in modern market history, and every single time it appeared, the asset in question went parabolic within 72 hours. This is not a drill. This is not clickbait. This is technical analysis meeting reality in real time, and if you miss the first 2 hours of this move, you are about to understand exactly what kind of trap just closed on the bears who were waiting for a dip that will never come. The chart opened at 8 p.m., not 8:01, not 7:59, exactly 8 p.m. Eastern when the futures market unlocked for Sunday night trading. Friday's close was $76.42. The opening print tonight was $80.18. That is a $3.76 gap. That is not a typo, that is not a glitch. That is a 4.93% gap on the open, with zero price discovery in between. There is empty space on that chart. White space, a void. And for the last 2 hours and 17 minutes, every single trader with a short position has been praying, begging, sacrificing to whatever market god they believe in for that price to come back down and fill that gap at $76. It has not happened, it is not happening. And I am going to explain to you in excruciating technical detail why that gap will never fill, what it means, and why the people who are sitting on the sidelines right now waiting for a better entry are about to watch this thing run to $90 without them. But before I do that, I need you to understand something about the algorithm that controls whether you even see this video. YouTube does not want you watching this. They do not want technical analysis that contradicts the narrative. They do not want retail traders getting information in real time. The moment I hit publish, this video enters a suppression queue. It gets shown to 10% of my subscribers, maybe, if I'm lucky. The only way you force this data onto the public feed is by hitting the like button right now, not later. Not after you see if I'm right now. Because every like is a signal to the algorithm that this is not fringe content, this is not conspiracy, this is actionable intelligence that people need to see. So do it, smash it, fight the suppression. I am not asking nicely. This information has a shelf life of hours, not days. Move. Let's go to the chart. The gap opened at $80.18. In the first 15 minutes of trading, we saw a wick down to $79.85. That was the low. That was the test. The market gave the bears exactly one chance to cover at $79.85, which is still $3.43 above Friday's close. They didn't take it. Why? Because they were waiting for $76. They were waiting for the gap to fill. They were waiting for the common gap playbook to execute like it always does, except this is not a common gap. This is a runaway gap, this is a measuring gap, this is a continuation pattern, and if you don't understand the difference, you are about to get a very expensive education. Let me explain the mechanics. There are 4 types of gaps in technical analysis. 4. Not 2. Not it either fills or it doesn't. 4 distinct categories with 4 distinct statistical outcomes. The first is the common gap. This is noise. This is low volume overnight movement that gets erased within 24 to 48 hours. It fills, always. The second is the breakaway gap. This happens when an asset breaks out of a consolidation range with conviction. It might fill partially, but usually it holds because it represents a psychological shift. The third is the exhaustion gap. This happens at the end of a move when the last wave of buyers rush in right before the top. It fills violently because it's a trap. And the fourth is the runaway gap, the measuring gap, the one we are looking at right now. This gap happens in the middle of a parabolic move when supply completely evaporates and the market just jumps price levels because there are no sellers. It does not fill, it does not retrace, it accelerates. How do you know which gap you're looking at? Volume, time of day, context. Let's go through it. The volume on that opening candle was 47,000 contracts in the first 60 seconds. That is not a common gap. That is not algorithmic noise. That is institutional positioning. The time of day? Sunday night at 8 p.m. Eastern is when Asia wakes up. This is not New York. This is not London. This is Shanghai, Hong Kong, Singapore coming online and saying, we are not waiting for the dip. The context? We are coming off a week where the spot price closed at $76 after grinding up from $70 over the previous 10 trading days. That is a $6 move. A runaway gap in the middle of a trend projects the same distance ahead. If we started at $70 and gapped at $76, the target is $82, but we didn't gap at $76, we gapped at $80, so the new target is $90 minimum. I need you to sit with that for a second. The market is telling you, in real time, with price action, that $90 is the next psychological level. Not next week, not next month, this week. Possibly tomorrow. And the people who are sitting here saying, I'll wait for the pullback, are the same people who said, I'll wait for the pullback when it was at $70. They're the same people who said, I'll wait for the pullback when it was at $65. They're the same people who will be saying, I'll wait for the pullback when it's at $95. And by the time they finally capitulate and buy at $105, the move will be over, and they will have ridden the entire parabola in cash doing nothing. Let's talk about the psychology of the trapped short. This is important. This is where the fuel comes from. Every short position is a future buy order. You cannot close a short without buying. That is the mechanic. You borrow the asset, you sell it, and at some point you have to buy it back to return what you borrowed. The bear, who opened a short at $76 on Friday thinking, this is overbought, it's going back to $72, is now staring at an $80 open with a $4 loss per contract. But he's not panicking yet. Why? Because he believes in the gap fill. He believes in mean reversion. He believes the chart will come back to him. So he waits, and he watches. And the price holds at $80, then $80.50, then $81, and now he's down $5, and now he's sweating. And now he's doing the math on his margin account, wondering how much higher this can go before he gets a call from his broker telling him to deposit more capital or get liquidated. The moment that bear capitulates and covers, he becomes a market buy order. He is not waiting for a limit order to fill. He is not negotiating. He is hitting the ask at whatever price the market demands because his survival depends on getting out now. And when you have hundreds of these bears all covering at the same time, you get a short squeeze. You get vertical price action. You get candles that don't make sense. You get gaps that don't fill. You get runaway gaps. Now let me show you the historical precedent, because this has happened before and the outcome was identical every single time. I'm going to give you 3 examples, 3 data points, and you tell me if you see a pattern. Example 1, silver in April of 2011. The chart was grinding higher from $30 to $40 over 6 weeks. Slow, methodical. Then on a Sunday night, April 17th, 2011, the market gapped from $42 to $45 on the open. Bears waited for the gap fill. It never came. Silver hit $49.80 within 4 days. 4 days. The gap never filled. It held. It became support. And everyone who waited for a better entry watched the entire move happen without them. Example 2. Gold in August of 2020. The chart was climbing from $1,800 to $1,900 through July. Then on August 2nd, Sunday night futures open, the market gapped from $1,920 to $1,975, a $55 gap. The bears screamed overbought and waited for the retracement. It never came. Gold hit $2,070 within a week. The gap became the new floor. Everyone who sold into that gap expecting a pullback got run over. Example 3. Crude oil in March of 2022. The chart was rallying from $90 to $110 after the sanctions hit. Then on March 6th, Sunday night, the market gapped from $115 to $123, an $8 gap. The shorts were massive. The media was screaming bubble. The gap never filled. Crude hit $130 within 48 hours, and the bears who waited for $115 to cover got liquidated at $128. 3 examples. 3 runaway gaps, 3 parabolic moves, 0 gap fills. And every single time, the gap happened on a Sunday night when liquidity was thin and Asia was driving the price action. You see the pattern now? This is not random. This is not luck. This is market structure. This is how breakouts happen in the futures market when the Western banks are closed and the Eastern buyers are awake. Let's do the math live because I want you to see the numbers in real time. If the move started at $70 and we are now at $80, that is a $10 move. A runaway gap typically occurs at the midpoint of a trend. That means we have another $10 to go. $80 plus $10 equals $90. But let's be conservative. Let's say I'm wrong about the midpoint theory. Let's say this gap only projects a Fibonacci extension of 1.618 times the initial move. The initial move was $6 from $70 to $76. Multiply $6 by 1.618 and you get $9.70. Add that to the gap level of $80 and you get $89.70. Round it to $90. Every mathematical model, every technical projection, every historical precedent is screaming the same number, $90. And we are sitting here at $81 right now, 2 hours into the Sunday session, and people are still asking, should I wait for a dip? I need you to understand the opportunity cost of waiting. If you are sitting in cash right now, you are making a bet that this price will come back to you. You are betting against the gap. You are betting that the market will give you a second chance at $76 or $78 or wherever you drew your imaginary line in the sand. But here's the problem. Every minute you wait is a minute you are not compounding. If this thing runs to $85 tomorrow and you finally capitulate and buy, you just gave up $4 of upside because you were waiting for a dip that never came. And if it runs to $90 by Tuesday, you gave up $9. And if it keeps going to $100, you will spend the rest of your life telling people, I was watching it at $80, but I wanted to wait for a pullback. Let me tell you what's happening right now on the institutional side, because this is where the real game is being played. The big money is not waiting for dips. The big money does not trade like retail. The big money builds positions over weeks and months using algorithms that accumulate slowly without moving the price. They front run the breakout. They know when the gap is going to happen because they are the ones creating it. How? Liquidity withdrawal. Let me explain. The market is not a free-floating auction where buyers and sellers meet in the middle like they teach you in Economics 101. The market is a series of liquidity pools managed by market makers who set the bid-ask spread and control the order flow. When a market maker wants to gap the price, they do not need to buy their way up tick by tick. They just remove the sell-side liquidity. They pull their offers. They create a vacuum. And when the market opens on Sunday night and the first wave of buy orders hit, there is nothing between $76 and $80 because the market maker removed all the intermediate price levels. The gap is artificial, it is engineered, but the outcome is real. The bears are trapped, the shorts are forced to cover, and the runaway begins. This is not conspiracy. This is market mechanics. This is how every single parabolic move starts. The institutions accumulate in the $60s and $70s while retail is scared. Then they gap the price to $80 to shake out the weak hands and trap the shorts. Then they sit back and watch the short squeeze carry the price to $90, $100, $110, while they slowly distribute their positions to the retail FOMO buyers who finally capitulate at the top. It is the same playbook. It happened in 2011. It happened in 2020. It happened in 2022. It is happening right now. I need field intelligence from you right now. I need you to go into the comments and tell me what you are seeing in your market. Are you watching this live? Did you buy the gap or are you waiting? Are you short right now? Tell me, because the data I have access to is limited to the screen in front of me. I can see the futures price. I can see the volume. I can see the order flow. But I cannot see the sentiment. I cannot see the fear. I cannot see the regret. You are my eyes on the ground. You are the real-time sentiment indicator. So go to the comments right now and give me a field report. What is your position? What is your plan? Are you in or are you out? I need to know if the retail crowd is still skeptical or if the FOMO is starting to build. Comment below. Do it now. Let's talk about the villain in this story, because every market move has a villain. And in this case, the villain is the algorithm that paints the tape. I'm not talking about your retail trading bot. I'm not talking about some kid's Python script. I'm talking about the institutional high-frequency trading algorithms that execute billions of dollars in orders per second and control the majority of the volume in this market. These algos are not designed to find fair value. They are designed to extract profit from volatility, and the way they do that is by creating whipsaw price action that forces retail traders to buy high and sell low. The algo does not care about fundamentals. It does not care about supply and demand. It does not care that there is a physical shortage or that China is buying. The algo cares about one thing: liquidity pools. It scans the order book looking for clusters of stop-loss orders and limit orders. When it finds a cluster, it attacks. If there is a massive wall of stop-loss orders sitting at $76 from all the longs who bought at $75, the algo will drive the price down to $76, trigger those stops, grab the liquidity, and then reverse. If there is a cluster of short covering orders sitting at $81, the algo will spike the price to $81, force those shorts to cover, and then dump it back down. This is called a liquidity sweep. This is the game. But here's the thing. When a runaway gap happens, the algo loses control. Why? Because the gap creates a liquidity void. There are no stop-loss orders sitting in the middle of a gap because there was no trading in that range. The price went from $76 to $80 in a single tick. There is no data, no volume, no orders, just empty space. And when the algo tries to sweep back down to find liquidity, it hits the void and realizes there is nothing there. So it stops. It recalculates. And it pivots to the only logical play, which is to chase the breakout higher because that is where the new liquidity is forming. This is why runaway gaps do not fill. The algo has no incentive to fill them. The market makers have no incentive to fill them. The only people who want the gap to fill are the retail bears who are underwater on their short positions, and they do not control the price. They are passengers. They are fuel. They are the exit liquidity for the institutions who are taking profit at $90, $100, $110. Now, let's talk about the geopolitical angle, because this is not happening in a vacuum. This is not just a technical pattern. This is a global supply shock meeting a futures market that is running out of deliverable inventory. I'm going to say that again. The futures market is running out of deliverable inventory. That means the paper price and the physical price are decoupling. That means the COMEX and the LBMA are in a liquidity crisis. That means the banks who are short these contracts cannot deliver the physical metal if everyone stands for delivery. And when that realization hits the mainstream, when the CME group issues a force majeure notice, when the bullion banks declare bankruptcy, the gap we are looking at right now at $80 is going to look like a rounding error. China has been importing record tonnage every single month for the past 18 months. I'm not talking about modest increases. I'm talking about year-over-year growth of 40%, 50%, 60% in some months. They are pulling physical metal out of London, out of New York, out of Zurich, and shipping it to Shanghai, where it disappears into private vaults and sovereign reserves and never comes back to the Western market. The Chinese are not buying paper contracts. They are not speculating on futures. They are taking delivery. They are accumulating the physical asset. And every ton they remove from the Western vaults is one less ton available for the COMEX to deliver against the open interest. The open interest on the COMEX right now is approximately 190,000 contracts. Each contract represents 5,000 ounces. That is 950 million ounces of paper claims. The registered inventory, the amount of metal that is actually available for delivery, is approximately 40 million ounces. Do the math. That is a 3-to-1 leverage ratio. 23 paper claims for every 1 physical ounce. If even 5% of those contract holders stand for delivery, the COMEX is insolvent. If 10% stand for delivery, the entire fractional reserve system collapses. And when that happens, the price does not go to $90. It goes to $200. It goes to $500. It goes to whatever price is necessary to make the longs go away because there is no metal to deliver. This is not speculation. This is math. This is the same math that caused the London gold pool to collapse in 1968 when the European central banks realized the US did not have enough gold to back the dollar. This is the same math that caused the Hunt brothers squeeze in 1980 when the COMEX changed the rules mid-game to prevent delivery. This is the same math that caused the palladium squeeze in 2000 when Russia stopped exporting and the price went from $200 to $1,100 in 6 months. History does not repeat, but it rhymes, and the rhyme scheme right now is screaming shortage, squeeze, and force majeure. Let's go back to 1933 for a second, because this is important context. On April 5th, 1933, President Franklin Delano Roosevelt signed Executive Order 6102, which made it illegal for U.S. citizens to own gold. The government confiscated the gold at $20.67 per ounce, and then immediately revalued it to $35 per ounce, which was a 69% devaluation of the dollar overnight. The people who held paper dollars got destroyed. The people who held physical gold, even though it was confiscated, at least got compensated at the new price. The people who held nothing got nothing. Why did FDR do this? Because the banking system was insolvent. The Federal Reserve had printed too much money. The gold-backed dollar was a lie. The reserves were not there. And the only way to save the system was to confiscate the gold, revalue it higher, and recapitalize the banks using the accounting gain. It was theft. It was legal theft. But it worked. The system survived. And the people who saw it coming and bought gold before the confiscation were the only ones who preserved their wealth through the crisis. Now let's fast forward to 1971. August 15th, 1971. President Richard Nixon goes on national television and announces that the U.S. is closing the gold window. No more gold redemptions for foreign central banks. The dollar is now a pure fiat currency backed by nothing except the promise of the U.S. government to pay its debts. What happened next? Gold went from $35 to $850 over the next 9 years, a 2-4 times return. The people who owned gold in 1971 became wealthy. The people who trusted the dollar got crushed by inflation. Are you seeing the pattern? Every time the monetary system breaks, the government changes the rules. They confiscate, they devalue, they print, and the people who are holding the hard assets survive. The people who are holding paper promises get obliterated. We are in the early innings of the same cycle right now. The national debt is $36 trillion. The deficit is $2 trillion per year. The Federal Reserve's balance sheet is $7 trillion. The repo market is in crisis. The banks are insolvent. The only question is whether they confiscate the metal before or after the price goes parabolic. Let me give you the current situation as of right now. 10:17 p.m. Eastern Time on Sunday, February 8th, 2026. The price is sitting at $81.35. It has not retraced below $80 since the open. The volume is accelerating, the bid-ask spread is widening, the order flow is showing institutional accumulation. The put-call ratio is flipping bullish. Every single technical indicator is confirming the breakout. The moving averages are aligning, the MACD is crossing. The RSI is in the 60S, which is not overbought in a bull market, it is confirmation. The Bollinger Bands are expanding. The price is riding the upper band, which is what happens in a trending market. This is not a reversal setup, this is a continuation setup, this is a runaway gap. And yet I am still seeing comments on my previous videos from people saying, I'm waiting for $75, or I'm waiting for $70, or I'm not buying until it crashes back to $60. Those people are going to be waiting forever. They are going to watch this thing run to $100, $120, $150, and they are going to tell themselves it's too expensive now at every single level because they missed the initial move and they cannot psychologically accept buying at a higher price than where they first saw it. This is called anchoring bias. This is why retail loses. The professionals do not anchor. The professionals chase momentum. The professionals buy breakouts. And the professionals are making money right now while the retail crowd is paralyzed by analysis paralysis. Let me make this very clear. I am not telling you to buy. I am not your financial advisor. I am not licensed. I am not regulated. I am a guy with a YouTube channel who reads charts and connects dots. You make your own decisions, you take your own risks, but I am telling you what I am seeing. And what I am seeing is a technical pattern that has a 100% success rate in the historical data set. 3 examples, 3 runaway gaps, 3 parabolic moves, 0 failures, and we are watching the 4th example form in real time. If you choose to ignore it, that is your choice. If you choose to wait for a dip, that is your choice. But when you are sitting here in 3 days watching this thing trade at $90 and you are kicking yourself for not acting when you had the chance, do not come into my comments section and blame me. Do not say you should have told me to buy. I am telling you right now, the gap is not filling. The breakout is confirmed. The target is $90 minimum. The risk reward is asymmetric. The setup is textbook. The opportunity is live. Now let's talk about what happens if I am wrong. What if the gap does fill? What if the price crashes back to $76 tomorrow morning? What is my downside? From $81 to $76 is a $5 loss. That is 6.2% downside. What is my upside if I am right? From $81 to $90 is a $9 gain. That is 11.1% upside. The risk-reward ratio is 1, 8, 2, 1. That is a positive expected value trade. Even if I am only right 50% of the time, which I am not because the historical win rate is 100%, but even if I am only right half the time, the math works. You take that trade every single time, you size it appropriately, you manage your risk, you set your stop loss at $79 if you are conservative or $77 if you are aggressive, and you let it run. But here is the thing. I am not wrong. I know that sounds arrogant. I know that sounds overconfident. But I have been doing this for 15 years. I have watched every single major breakout since 2008. I have studied the patterns. I have backtested the setups. I have lost money on bad trades and made money on good trades, and the lesson I have learned is this. When the market gives you a textbook signal with historical precedent and mathematical confirmation, you do not fade it. You do not fight it. You do not wait for a better price. You take the trade. You trust the process. You execute the plan. The people who wait for certainty never make money in the markets. The people who wait for the news to confirm the trend are already too late. The people who need CNBC to tell them it's safe to buy now are the exit liquidity for the smart money who bought weeks ago. The information is in the price. The price is the news. The chart is the truth. And the chart is telling you right now at 10:32 p.m. on Sunday night that the gap is not filling and the target is $90. I need you to subscribe to this channel right now if you are not already subscribed. I do not know how long this platform allows me to operate. I do not know when the next terms of service violation or community guidelines strike or algorithmic suppression is going to shut me down. What I do know is that the information I provide here is real-time, it is actionable, and it is not available anywhere else in this format. The mainstream financial media is not going to tell you about runaway gaps. Bloomberg is not going to explain market structure. CNBC is not going to show you the COMEX inventory data. They are going to feed you the narrative that benefits their advertisers, which are the same banks that are short this market and losing billions of dollars on this move right now. You need to be subscribed with notifications turned on so that when the next leg of this move happens, when the price breaks $90, when the COMEX issues a delivery notice, when the banks declare force majeure, you get the alert immediately. You do not find out 3 days later when it is already over. You find out in real time so you can act. So hit the subscribe button, turn on notifications, join the archive. This is not a request. This is survival information. Let me give you the game plan for the next 72 hours, because this is how I am trading it, and you can choose to follow or not. The current price is $81.35. My target is $90. My stop loss is $77.50. That gives me a 2-to-1 risk-reward ratio. If the price breaks above $83, I am adding to my position because that confirms the next leg. If the price breaks $85, I am moving my stop loss up to $81 to lock in profit. If the price hits $90, I am taking partial profit and letting the rest run with a trailing stop, because if this thing goes parabolic, the target is $100, $110, maybe higher. I do not know where it tops, nobody knows, but I know where it is going next, and where it is going next is up. The people who are short right now are in pain, real pain, financial pain. The people who sold at $76 thinking it was the top are watching their position go negative by the hour. The people who are waiting for a pullback to buy are experiencing FOMO, fear of missing out, the psychological torture of watching an asset you want to own go up without you. And that FOMO is the fuel. That is what drives the parabolic move, because at some point the pain becomes unbearable. The shorts capitulate, the sidelined buyers panic, and everyone rushes in at the same time. That is the short squeeze. That is the blow-off top. And we are not there yet. We are in the middle. We are in the runaway phase. The panic has not started. The squeeze has not happened. This is still the accumulation phase for the smart money. This is still the denial phase for the retail crowd. Let's talk about what a runaway gap looks like on the chart in the days after it forms. The price does not consolidate, it does not chop, it trends. It makes higher highs and higher lows in a clean, orderly fashion because the supply has been exhausted and the demand is accelerating. You will see small pullbacks, maybe 1% or 2%, but they get bought immediately. You will see dips to the previous hour's low, but they do not break. The market is in discovery mode. It is searching for the level where the sellers come back, and until it finds that level, it keeps climbing. The Fibonacci retracements are useless in a runaway gap environment. The Elliott wave counts are useless. The support and resistance levels from the previous range are useless because the market has left that range and it is not going back. The only thing that matters is momentum. The only thing that matters is the trend. The only thing that matters is staying on the right side of the move, and the right side is long, the right side is bullish, the right side is positioned for $90. I'm going to tell you a story. In 2011, I was watching silver every single day. I had been accumulating since $18. I watched it grind to $25, then $30, then $35, and then on that Sunday night in April, when it gapped from $42 to $45, I did what every retail trader does. I said it's overbought, and I waited for the pullback. I waited for the gap to fill. I watched it go to $46, $47, $48, and I kept waiting. And when it finally topped at $49.80 on the following Thursday, I had missed the entire final leg of the move because I was waiting for a dip that never came. I learned my lesson. I will never make that mistake again. When the market shows me a runaway gap, I buy it. I do not question it. I do not wait for confirmation. I execute. That lesson cost me thousands of dollars in opportunity cost, but it taught me more about market psychology than any book or course ever could. It taught me that the market does not care about your analysis. It does not care about your indicators. It does not care about your opinion. The market does what it does. And your job as a trader is not to predict it. Your job is to react to it. Your job is to recognize the pattern and execute the trade. And the pattern right now is screaming runaway gap. The shorts are trapped. The gap is holding. The volume is confirming. The Asia session is bidding. The institutions are positioned. The technicals are aligned. The fundamentals are supportive. The sentiment is shifting. The momentum is building. And the price is going to $90. That is not a prediction. That is not a guess. That is a mathematical projection based on historical precedent and technical analysis. And if you choose to ignore it, you will watch it happen without you. Let me address the skeptics in the audience right now. The people who are saying this is just hype, or you're pumping your bags, or you're going to be wrong eventually. You're right. I will be wrong eventually. Every trader is wrong eventually. The question is not whether you are right or wrong on any single trade. The question is whether you have a system that produces a positive expected value over time. And my system is based on historical patterns that have a 100% success rate in the specific context of Sunday night runaway gaps in bull markets. 3 examples, 3 wins, 0 losses. That is not luck. That is not cherry picking. That is pattern recognition. That is edge. If you want to sit on the sidelines and criticize, that is your right. If you want to wait for the gap to fill so you can say, I told you so, be my guest. But while you are waiting, I will be making money. While you are analyzing, I will be executing. While you are debating, I will be compounding. And when this thing hits $90 and you are still in cash, you will have plenty of time to reflect on whether your skepticism was worth the opportunity cost. The time is now 10:51 p.m. Eastern. The price is $82.14. It just broke above $82 for the first time. The next resistance level is $83.50. If we break that, the path to $85 is open. If we break $85, the path to $90 is clear. This is happening in real time. This is not a replay. This is not a backtest. This is live price action, and you are watching it happen. The question is, are you positioned or are you waiting? I'm going to end with this. The market rewards action. It rewards decisiveness. It rewards the people who are willing to take calculated risks based on probabilistic outcomes. The market punishes hesitation. It punishes indecision. It punishes the people who need 100% certainty before they act. If you are waiting for certainty, you will never make money. If you are waiting for the perfect entry, you will never enter. If you are waiting for the gap to fill, you will watch the breakout happen without you. The gap is not filling. The runaway is confirmed. The target is $90. Subscribe to the channel, turn on notifications, hit the like button to fight the algorithm. Comment below with your position. And if you appreciate the real-time analysis, if you want to support independent research that is not controlled by the mainstream financial media, consider hitting the super thanks button or joining as a member. This is not a paywall. This is not a subscription service. This is voluntary support for information that you cannot get anywhere else. Do it if you find value. Ignore it if you don't. But do not ignore the chart, do not ignore the gap, do not ignore the signal, because the market is speaking and it is saying one thing: up